Welcome back. Today we are breaking down KOF Coca-Cola FEMSA using only the provided caveat investment reports. The goal is simple. Separate the headline signal from the actual risk and decide how a retail investor might think about the stock. The first thing to understand is that KOF is not being presented as a speculative technology name or a high beta momentum gamble. The source frames it as a defensive growth opportunity, a steady consumer staples business with improving technical momentum and a stock chart that is currently working. That distinction matters. A defensive growth stock can still have upside potential, but the path is usually different. Instead of explosive revenue acceleration, the argument is built around business quality, distribution strength, margins, valuation discipline, and whether buyers continue to support the price above key moving averages. The executive summary is direct. The near-term signal for 1 to 5 days is buy. The swing signal for 3 to 15 days is also buy. The preferred horizon is both, because the 4-hour chart and the daily chart are aligned in the same bullish direction. The bottom line from the technical report is that KOF recently cleared its 20-day and 50-day moving averages with increasing volume. The stock is described as being in a clear uptrend, supported by a bullish MACD crossover and an RSI that is trending toward 60. That does not mean the trade is risk-free. The report also highlights the key obstacle. KOF is approaching its year high at $116.36. That level can act like a psychological ceiling, because traders who bought earlier may choose to take profits there. For the near-term setup, the 4-hour chart is the main focus. The source says price is holding above the 4-hour 200 simple moving average at $104.71. And recently broke above the $108.50 consolidation zone. Momentum is supportive. The 4-hour RSI is listed at 58.18, and the MACD histogram is positive at 0.342. In plain English, the report sees sustained buying pressure, but not an extreme overbought reading that would automatically kill the setup. The proposed near-term entry trigger is a retest of the $109 level. That level matters because it was previous resistance and may now become support. The source gives the entry zone as $108.80 to $109.20. Risk management is clearly defined. The near-term stop is $107.50, below the 4-hour 20 simple moving average. The targets are $111.50, then $113.50. The stated risk-reward ratio is about 2.5 to 1. That is important for retail investors because a buy signal by itself is not a trade plan. The source is not saying buy at any price. It is saying the setup is attractive if the trader can enter near the plan zone, keep the stop tight, and avoid chasing into resistance. The swing setup has a similar tone, but it uses the daily structure. The source says KOF is printing higher highs and higher lows while trading well above the 200-day simple moving average, which is listed at $95.85. The 4-hour chart confirms the daily breakout, and the weekly RSI at 63.3 still leaves room before the stock reaches a more obvious overbought zone. That is why the report calls the swing technical factors strong, aligned, and high confidence. For the swing plan, the entry zone is $109 to $109.50. The stop is $105.50, tied to the daily pivot support level. The main target is $115.50, with an estimated risk-reward near 3 to 1. The management instruction is also worth noting. The source suggests using the 4-hour 50 simple moving average as a trailing stop for the swing position. That creates a disciplined way to stay in the trade if momentum continues while still having an exit if trend structure weakens. Now let us move from the chart to the news sentiment. The sentiment report describes overall sentiment as positive, but only moderate strength, with medium confidence. The key drivers are strong first quarter 2026 earnings performance and positive market momentum. The source says KOF was trading around $109.55, reflecting a 1.95% gain. That price action suggests the market reacted favorably to recent financial disclosures and operational updates, even though the sentiment is not described as overwhelmingly bullish. One unusual point in the source is information noise. A significant amount of KOF search activity refers to King of Fighters, the video game franchise, plus unrelated social media content. The report says investors should filter that out because it has zero impact on Coca-Cola FEMSA's financial picture. After filtering that noise, the sentiment picture remains robust. The source estimates that 80% of relevant financial signals are positive, mostly earnings performance and price appreciation, while 20% are neutral, mainly standard valuation metrics. The most impactful event is the first quarter 2026 earnings call from April 29th. The report calls it a major positive because it provided a fundamental health check, and the market's positive price reaction indicates that results met or exceeded investor expectations in the eyes of market participants. There is also an important nuance. Another section says earnings per share of $1.18 missed the estimated $1.41, but the market largely shrugged this off and focused instead on revenue resilience. That is a classic example of price action helping interpret the headline. The sentiment report identifies no major negative developments. It says there are no reports of missed earnings in the sentiment dataset, management turnover, or regulatory hurdles. The only moderate negative it emphasizes is market noise, which is a nuisance for research rather than a business problem. Next, the investment analysis. The longer-term report gives KOF a buy recommendation with 78% confidence, an optimal timeframe of 6 to 12 months, and setup quality of 85 out of 100. That is the source's strongest investment-oriented rating. The investment thesis calls Coca-Cola FEMSA a compelling defensive growth opportunity. As the world's largest Coca-Cola franchise bottler, it combines the stability of consumer staples with operational efficiency and scale. That is the core reason the stock can appeal to investors who want quality without chasing speculative growth. The first key driver is operational efficiency. The company maintains a gross profit margin of 46% and a negative cash conversion cycle of negative 0.49 days. That means the company collects cash from customers faster than it pays suppliers, a sign of an efficient business model. The second driver is valuation. The source says KOF trades at a price-to-earnings ratio of about 17 times, which is attractive for a company with double-digit 3-year earnings growth. The forward PEG ratio is listed at 1.67, suggesting reasonable pricing relative to growth. The third driver is technical momentum. The stock is trading above its 50-day and 200-day moving averages, which supports the idea that the market is rewarding the business. The report says the breakout above the $107 level confirms that buyers are in control. The fundamental dimension score is 82 out of 100, with a 40% weighting. The source highlights 2025 fiscal year EPS growth of 25.66%, an EBIT margin of 14.66%, and more than $7.20 in free cash flow per share. The technical dimension score is 80 out of 100, with a 30% weighting. The price near $109.55 is comfortably above the 200-day simple moving average, and the recent move toward $109.92 shows the stock testing the upper end of its range. The sentiment dimension score is 75 out of 100, also with a 30% weighting. Analysts are described as maintaining a consensus buy rating with a median price target of $115, and the lack of strong sell rating suggests institutional confidence. When the source integrates fundamentals, technicals, and sentiment, it gives an overall score of 79.6 out of 100. The report says the alignment between strong margins, cash flow, moving average support, and positive analyst sentiment creates a high probability setup. But we also need to respect the opposing view. The quick take section gives a hold rating with 65% confidence. It does not say the company is weak. Instead, it argues that the stock is fundamentally sound but may move sideways over 3 to 6 months because growth is modest. That hold section describes KOF as the largest franchise bottler of Coca-Cola products by sales volume, operating primarily across Latin America. It benefits from a massive distribution network and deep brand loyalty, but its performance is tied to local consumer spending and currency fluctuations against the US dollar. The numbers that matter in that section are revenue growth of 4.27%, operating margin of 14.05%, P/E ratio of 17.14 times, return on equity of 16.39%, and debt to equity of 0.65. The bull case says KOF has pricing power. As a dominant bottler, the company has historically demonstrated the ability to pass inflationary costs to consumers without major volume loss. The efficiency gains and negative cash conversion cycle further support the quality argument. The bear case worries about currency headwinds and the growth ceiling. Since KOF is connected to Latin American markets, a strengthening dollar can reduce reported earnings. And with revenue growth of 4.27%, investors looking for rapid appreciation may find the profile underwhelming. That is why the source can contain both buy and hold language without being contradictory. Re-up applies to the active technical setup and the 6 to 12-month defensive growth thesis. Hold applies to investors who already own it or who require a stronger catalyst before adding exposure. For swing traders, the analysis is practical. The setup is strongest if price pulls back toward the entry zone instead of breaking straight into the year-high resistance area. A disciplined trader wants the upside to $113.50 or $115.50 without taking uncontrolled downside risk. For longer-term growth investors, the source says KOF can be a core defensive holding that offers capital appreciation and dividend stability. The key is not expecting it to behave like a speculative rocket ship. The report explicitly calls it quality at a reasonable price. For investors who already own the stock, the action plan is hold. The trend is intact, and the source says there is no technical or fundamental reason to exit at this time. That changes only if the trend structure fails or the risk indicators deteriorate. The risk checklist is straightforward. Watch currency volatility, especially a strengthening dollar. Watch input costs, especially sugar and PET plastic. Watch regulation, including sugar taxes or health-related rules. And watch the gross profit margin. The source says a drop below 40% would pressure the thesis. The monitoring checklist also includes revenue growth above 4%, operating margin above 14%, debt to equity staying below 0.8, and interest coverage staying above 3 times. Positive confirms include dividend growth and progress on digital transformation initiatives like Unitos Plus. So what is the final buy or sell analysis? Based strictly on the source, KOF is not a sell. The business is stable, the chart is constructive, sentiment is positive, and the risk levels are clearly defined. The real decision is between buying dips and holding existing exposure. My production takeaway from the article is this. KOF offers upside potential toward the $113 to $115 area in the active setup, with the year high at $116.36 as the key ceiling. That is the level to respect. Bottom line, the source frames KOF as a buy for traders who can enter near the planned support zone. a buy for growth investors who want defensive quality, and a hold for investors already positioned. This is informational only, not financial advice. Always do your own due diligence.